Hello, Jason Sharp here of CapX Ventures. I'm here to present a little bit of an update. We wrapped up the big US presidential election and more just a week and a half ago at this point, 2 weeks ago. It's all been a blur. But we've had a lot of questions as to what that means to the landscape of energy, oil and gas, uh, Bitcoin, all of the interesting things out there, because we definitely have a very different administration in flight, in flux, coming back into play, something more pro-energy. And so what that might mean, good, bad, who knows? But I've spent some time to get some references and resources for all of us to paint a slightly clearer picture. Without further ado, I'll dive right in. So from our agenda, I'm going to go ahead and spend a little bit of time here on what kind of changes the Republican side has, and also what we've learned from Trump's first term in office, in contrast to what's been going on with the Biden administration. So policy and geopolitical impacts. We'll also take a look at some market dynamics, in particular with the OPEC Plus, which includes Russia. Demand and transition scenarios, as we talk a little bit about the green movement and how the move towards sustainable and green energy may be adjusting. And then, of course, wrap it all up with investment risks and opportunities. What I will also add is kind of what that paints from our latest projections for Fund 6, CapX Ventures Fund 6, the offering that's currently open. All right. So starting things off here, U.S. policy changes. With the Republican side of things, it is about rolling back some clean energy incentives. But honestly, a lot of this is about optics, and I'm going to focus on that for a few things that I'll state. But one, for example, is that while we've had a very green-friendly administration with Biden for the past several years, it's about the optics. At the same time, we're at the greatest oil production levels our country has ever had. These are some of the bits that that administration didn't want to advertise for fear of frustrating and disappointing and angering their green supporters. But fossil fuels are alive and well under Biden. But also all of the subsidies for the green energy direction have basically been petering out somewhat on their own. And it was going to be very interesting to see how they could continue to be funded as time wore on, had this gone into a Harris administration. But with Trump and the Republicans, we're definitely expecting rollbacks of clean energy incentives, so making them a little bit more front and center to demonstrate a more pro-energy, pro-fossil energy agenda. Also, restocking the SPR, the Strategic Petroleum Reserve. I'll show you on the next slide what state that sucker is in. One other thing is we're going to have rather quickly, in fact, I would say the geopolitical sides of things, we've already had some big announcements just in the past week and a half since Trump was pronounced the winner. We've got Hamas towing the line and basically calling for an end and giving up. Iran is going to get most likely choked out again. This is where Trump in his first term was trying very hard to basically suffocate the regime with oil sanctions. And then that had pretty much reversed itself with the Biden administration once they were basically negotiating to get hostages released. So it gave a huge boost of income back to Iran, funded lots of naughty behavior, but the Trump win is definitely telegraphing a fairly drastic return to restricting the Iran exports. What that's going to do is basically balance things out to where, okay, drill, baby, drill. We're going to have a bunch of pros and cons, or some increases and negatives, pluses, minuses, for producing more fossil fuels on the U.S. Within the U.S. country. But on the other hand, we're going to have reduced production in certain parts of the world, or greater consumption that's happening. So Iran is definitely going to be feeling a lot of heat, a lot of pain. And what we're also going to see is a lot less volatility across the landscape of international politics. If there's one thing that Trump had demonstrated in his first term was much more rhetoric that was very, very clear, followed by very, very clear action. And it was something that the international stage could actually follow. Now, they may complain and do a whole bunch of pomp and circumstance, but it was a lot better than ignoring it. So we're expecting that that's going to actually lessen a bit of the volatility, and that tends to be great for markets. That tends to be great for economies. That also will lead itself to much greater consumption. Speaking of consumption, there's one way that the US has been keeping gas prices, as in your automobile gas, relatively cheap, despite the fact that all this other inflation has gone up significantly higher. And one of those reasons is basically raiding the SPR, the US Strategic Petroleum Reserve. And if we are to look at what that reserve volumes we're keeping, the energy stocks of oil that we had going back over 40 years. August of 1982 is the oldest I could find from the US Energy Information Administration, all the way up through November 1st. And what we see here is a surge that continued, leveled off back in the late century, and then early in the millennia, that we found ourselves bumping up to roughly about 700 million barrels. And then we found ourselves January 2021, when Biden took office, to basically at its peak of 638 million barrels, having it drop down basically 40% over the intervening recent years, 2 to 3 years, to where we had ourselves 387 million barrels, where we find where we are today. It dipped as low as 347. That's what this dip is. But at November 1st, 387. The last time the Strategic Petroleum Reserve was at that level, we'd have to go back basically over 40 years, at March of 1984. That's when it was on its way up at that same level, right at about here. So pretty drastic change there. And we fully expect that things to kick in gear with the Trump administration to refill that reserve. That's going to go a certain distance, of course, to consume a bunch of additional production. So we've had with OPEC Plus a couple advertised timelines where they would increase production. And if you increase production, the expectation is a glut on the market, so prices would come down. But what we've gotten to see is that they've continually delayed production because for some reason or another, as a whole, OPEC Plus has basically deemed that $70 floor to be of particular importance. Anytime that it was looking like they would be, nearing the point of having that drop below $70, they would delay production or even tighten things up, delay production increases. So this is rather interesting because we're not expecting, as a result, the glut on the market that occurred if we were to roll things back to before 2020, when there was so much on the market, primarily because Saudi Arabia was trying to starve Iran and a little bit Russia, but starve Iran by dropping prices. And there's two ways to do it, right? One way is to go ahead and restrict Iran from exporting its oil reserves. On the other hand, you could make oil so cheap that whatever they export, that they're not getting the revenue for it. And that was the attempt done before. But if everything is going to happen as is suspected, where sanctions on Iran are going to be so vicious, then OPEC has no interest on their own from their side to dropping these prices. So with all of that, we expect them to manage supply fairly evenly. So let's talk about energy transition in some kind of a demand plateau. So by and large, fossil fuels are the only thing on the horizon that can deliver power now. There's a lot of growth that has happened with windmills, but especially with solar. In fact, it's remarkable, when we're flying as a pilot and I'm zipping around to check up on our fields or the apartment complex or just personal trips, is that you get to see these sprawling solar fields that are just growing and growing, especially around the flat plains of Texas, central Texas, north central. So it's pretty impressive to see. But what ends up happening with all of that is we've got way too much demand. The demand is just growing phenomenally, and not just overseas, but even within the country as we've brought back more, and especially with Trump, we're expecting even more of manufacturing to return, industry demands, and the elephant in the room is big data and its newest, sexiest cousin, AI. Those AI data centers are touted to be so aggressively power hungry that it's basically adding several medium-sized cities to the US energy consumption grid. You need to also remember that we have some momentum going on the EV direction, the electric vehicle, and the charging required for that. So there's a lot of electrification, if I get that word right out of my mouth, that needs to happen. And in so doing, the power consumption in this country is just going to grow to phenomenal levels. Good news is we have the independence and the ability to do it, even as a combination of fossil fuels and green energy alternatives. But it needs to be subsidized by the fossil fuels for a very long time to come. Probably the only thing that can truly address the energy growth required for it over time is going to be nuclear, but even that is going to take at least 10 years plus for us to start making some kind of headway in that direction. So in the meantime, what we're finding is that fossil fuels will survive very well, and not just with what's going out of the ground and into market, but also what's coming out of the ground and then being converted on site with generators into electrical power. What's special about that? That's exactly how crypto mining works, because you've got vented or flared gas that has volumes too small to warrant the expense to take them to market. You've got liabilities that are coming in from the Inflation Reduction Act of big tariffs and taxes on those things, or penalties on those things. So it makes a lot of sense for folks to deploy on Bitcoin mining. And then not only that, but at night, whenever you've got all the energy demand that continues in our cities, municipalities, et cetera, but all of our solar power drops offline. Our wind tends to drop offline at night because that's when the winds tend to calm down. That's when the electricity created by those on-site generators can be basically diverted from data centers that are performing crypto mining and direct that into the power grids of the local places. So with all of that said, energy consumption is growing. And it eludes me right now, there's even a paradox that's explicitly named to reflect the fact that what we have demonstrated over and over as Western or technologically advancing societies is that we are reducing emissions, but as we increase our efficiency for producing energy, we're also finding more efficient ways to accomplish more things. And ultimately, it means more energy consumption. So it's kind of this tit for tat that just keeps climbing and climbing as we do it more efficiently and more cleanly. But at the same time, we're not at all slowing down on the energy consumption. So here's a picture, not one that I took from my plane because I couldn't take a better one, but that is one of these massive solar farms in Texas. So I mentioned earlier, got ahead of myself, is that especially due to the Inflation Reduction Act that included so many things, um, most of which none of us had any idea because it was this thick and rammed right through. And with a name like Inflation Reduction, what's not to like? But included in that was some pretty massive green energy incentives. One could call them incentives when you think it sounds like a positive, but some of it was just massively taxed and penalized and so forth. And that's a lot where gas production is going to be under quite the microscope. So natural gas is definitely the energy source that produces the cleanest of the byproducts. But at the same time, if it's done sloppily, as it's vented into the atmosphere, the environmentalists really frown on that. EPA frowns on that. And so there's a big effort to become more efficient at that aspect. But we're definitely not going to see gas go away. One thing I'll mention about gas, by the way, is something else dealing with optics. Um, Before Biden had announced a moratorium the uh, on the processing plants for natural gas to liquefy it in order to export it, because natural gas is not easily transported. It goes by pipe, and that pipeline takes it to a plant that will go ahead and separate out all the different methanes, all the different anes that go into these complex gases, and then furthermore takes out the non-gas liquids, the NGLs. So basically the condensate. All those things have value, but basically it gets uh, turned into its useful components and then converted into electricity at scale. Um, that doesn't transport itself very well to other parts of the world that are extremely hungry for gas, such as Europe, especially given the Ukraine and Russia scenario situation out there. So transporting it requires cooling that gas into a liquid. And what Biden had done was basically provided a moratorium on new um, uh, not new permits for creating those. That wasn't going to take effect as far as new things being built for years and years, but the optics of it made it seem like we were not going to be able to export. And unfortunately, that impacted absolutely our gas prices, which then tanked. Prior to that, our gas prices were a bit closer to the world market prices, and they were significantly higher. Do we think that they're going to climb that high? That's tough to tell because, again, it's more of an optics problem. We expect that the restriction on those with the pro-energy administration coming in is going to be much more positive and basically get back to giving the appearance of exporting, of having lots of exporting support for allies and other trading partners to get them gas from the US, where we can export this stuff. We have so much of it, it's unbelievable. So we'll see how that works. One last thing on this slide that I'll mention is that oil and gas investments are going to be expected to last through easily the 30s, 2030s, for basically outpacing the deployment of green alternatives, of renewable energies, because with our consumption growing and the fact that it's really the only thing that can satisfy the most efficient and available energy compared to anything else until we get nuclear online, we're going to keep ahead with a fairly decent investment landscape. So in conclusion, our performance outlook, both on a short term and then also long term. If we're talking about on the short term, we're expecting some of that volatility from some pretty decent changes, but they're already being telegraphed, but some pretty decent changes from the Biden administration into the incoming Trump administration. That's going to ripple outwards into the international space. So OPEC Plus is going to be adjusting. The Iran scenario is going to be adjusting. We're expecting lots of volatility from terrorism and from the the nation states that are really trying to rock the boat to basically get a bit calmer. Hopefully, that will be exactly what happens, but that's definitely what we're expecting. That's going to drive what we anticipate to be strong performance due to the global demand and supply management, because nobody's going to want these prices to tank. OPEC plus, the U.S. neither will want that to occur. And then meanwhile, lots more demand to be had, whether it's refilling the SPR, whether it's growing a rebounded economy, whether it's trading with our allies and partners. On the long-term side, um, as I mentioned, it's going to take a while before nuclear comes online in any kind of scale that will make a difference, that will move the needle. So in the meantime, renewables are going to continue to roll out, but it's going to be interesting to see how that adjusts due to the capital outlay, as we've got maybe some right-sized incentives for the renewables because they were so aggressively pursued under the Biden administration that in many ways they were starting to go bankrupt over and over. It'll be interesting to see how that balances out, how that stabilizes. So fossil fuels are going to be the ones to subsidize all of that energy consumption that we anticipate world over. So even in the long term, we expect this to have a pretty decent tail before anything of note starts coming in. All right. So what does that mean with our market opportunities? Well, we think that we've got a good place, good positioning, and in something that isn't going away anytime soon. The risks, I'd say nothing worse than what's been going on. Definitely better. So the risks are more of longer term. And if we're doing assets, investing in assets that have more of a 5-year lifespan before we would dispose of them, I'm feeling that that's how we can mitigate on what's happening on the longer term. But for now, we're feeling very bullish about these things for all the reasons I've mentioned. Hopefully, you find yourself in the same boat. So what might that mean with our Fund 6 projections? The 5-year strip after the election has definitely lowered itself. It shrunk a little bit, but not particularly that much. And there are much smarter folks than even all the ones who write all the articles and so forth, because they actually put their money where their mouth is in forecasting these futures. So these future strips have already baked in the market, as it were. The market has already baked in a pretty significant amount of all this reading the tea leaves of the administration and economical changes to come. So with that 5-year strip pricing as of Friday, November 8th, from before this weekend, we've also folded in a 40% annual ROI from our Bitcoin mine. That's, we feel, actually very conservative, especially with how much Bitcoin has boosted, given the likes of what Trump has said, and prior to that, Robert Kennedy and getting his information out there. Big proponent of Bitcoin. So with the crypto side of things going through the roof, we think that's very conservative. So always including our depletion, which is why first year is bigger and then it starts to shrink, any of the fees involved, and then an exit in year 5 is that we find ourselves with this path forward. So looking good to return and do a full payback in year 1, and then going through some depletion, but it's still pretty aggressive yearly returns. Because we're getting so much back early in the deal, that's what bumps the IRR up so high. But from a total ROI, 399% is obviously quite heady, but we're trying to be as conservative as we can on this production deal. So let's get this done. We're about 2 weeks away from beginning our first drill. We've got about 5 weeks to go before this thing closes. We're expecting somewhere between December 10th and December 20th for Fund 6 to close. Because the moment that we've got a well coming online, we're going to have to shut it down. shut down the offering because it's time to hang on tight and enjoy being in the deal instead of outside of it. Um, what's also going on is as I make this presentation for y'all is that our Bitcoin mine is actually getting deployed as I speak. So exciting things. And if you're not in this deal, I highly suggest you take a look at it and hopefully you'll be investing with us. Thanks for listening. Until next time.